All right. All right. Hey, what's up, guys? Hello, hello, hello. Okay. All right. So, as seen in the title here, we're going to talk briefly about rate cuts. Okay. So I've already discussed kind of the majority of what I personally am looking for when it comes to the Federal Reserve and the rate cuts, and especially as we head as we came to this month's meeting. So the last, I would say, month and a half or so, I've been building a case that we should be seeing, well, actually, I was already believing that there will be at least one rate cut in around, I would say, the first quarter of this year. And I gave you guys kind of just general information. But as we've gotten more data, I still am holding this. Well, it is now a contrarian perspective, because the majority of the markets are believing that across the board we'll be seeing an actual increase in probability for a rate hike. So this is my detailed version of what I've discussed about 2 months ago, or about a month and a half ago. Okay, so first of all, as you guys know, I've been really pointing this out for the last 2 weeks or so. Bond yields have been surging, okay, and if you just take a look at the 10-year, okay, let me show you guys this. Okay. Right now, whenever I mention 10-year or anything like that, I know a lot of people get reminded of the yield curve inversion that we had back in, I believe, 2022. But we didn't really see an official recession being declared since we decided to change the definition of that, right? Instead of having two quarters of negative GDP, they said that it wasn't essentially the definition of an economic recession, which was completely crazy. But yeah, so we've essentially were able to move away from designating the overall economy in 2022 being a recession. So a lot of people are now saying that that if we do see a yield curve inversion again sometime before the end of this decade, we will most likely be in an economic recession, and we won't be following the same definition that we saw in 2022 from economists and analysts as well. Okay, so now when regarding the 10-year here, okay, I truly believe that the 10-year is basically doing the Fed's job for them at this point, because it's so. I've seen personally a lot of people online saying that, like on like a FinTwit as well, that that it just makes sense that the Federal Reserve has to hike rates, right, at least once or twice before the year ends, right? And they might need to have more additional rate hikes into the first half of next year, but that's only because of the fact that they're looking at the yields, right? The 10-year especially. But I honestly have a case for the opposite, right? For the opposite of what they're saying, okay? And that's the reason why I'm saying that my perspective here is completely contrarian to what the majority of the markets are saying too. So first of all, before I move on into kind of why I think the bond yields are actually showing us something different than what the majority of people are saying, is that I want to give you guys the same perspective that I've had in late 2023. So if you remember from, I think it was around August of 2023, I gave everyone, I was shouting out at the top of my lungs, I was saying it consistently to the end of 2023 that we should be seeing our first rate cut ever, right? And we should be getting out of this easy money, this tight monetary policy from or actually, let me rephrase that. So I was specifically saying that in August of 2023 that we should be getting the very first rate cut sometime around late quarter 3 or early quarter 4 of 2024. And if you guys remember, come September of 2024, that's when we actually got that first rate cut. Okay, after seeing consistent rate hikes and tight monetary policy. So that was our first hint of kind of an easing of that monetary policy. Now, I'm gonna hold the same view, okay? So maybe around the September, or let me actually make sure that we have the right dates in mind. Yep, so right around September or October of this year, I think we can still have a single rate cut. So just like what I've said in August of 2023, okay, I think somewhere around late Q3 or early Q4, we could be seeing a single rate cut. And I am basically treating this as if they're about to have another first rate cut, because we've been pausing for months, right? The rates have been paused for months, and sitting at 3.50% through 3.75%. That's the federal funds rate right now. And when you just take a look at the data, okay, especially with the bond yields, just stick with me here, okay? It's gonna get a little bit boring because who really cares about the bond markets, right? But I've been following this for a couple weeks now as yields have been consistently rising, dangerously slow, and across global bond markets as well. If you guys take a look at the Japanese yields as well, which I've been following too, alongside with US bonds here, the entire US bond market actually, things are looking a little bit precarious. So let's get into the 10-year yield. Okay, so we hit, let's see, a new local high last week at 4.71%. Okay, so this is a 52-week high, by the way. Okay, so what we're looking at here is the weekly time frame, and I've already gone over the fact that yields are looking to be making some sort of a bull flag here, which is insane, right? Since we don't really need to do any type of charting on actual yields, but I mean, this is kind of hard to ignore, right? So last week with this 52-week high that we've been, hey, what's up guys? Hello, welcome. Anyone who's just joining us right now, make sure you guys hit that like button, and also please go back a couple minutes before this current time frame right now, because I've said some pretty important things. So just go back, or just continue to watch the current live, and you guys can watch the replay afterwards. So when it comes to 10-year yield, yeah, so we hit this 52-week high, right? And this is definitely a good reason to be bearish on overall equities as well, right? Because when these long rates are this elevated, okay, the bond market, they're basically tightening financial conditions independently of whatever the Federal Reserve is doing with the federal funds rate. Does that make sense? Let me say it one more time, guys. Okay, so when these long-term rates, right, these longer rates are this elevated, right, hitting a 52-week high at 4.71% last week, the bond market is already tightening financial conditions independently of whatever the Fed is doing with the federal funds rate. Okay, and right now, currently, since yields and even mortgage rates are correlated, mortgage rates are around 7%, right? And the overall bond yields are also contributing to just overall highs in anything else, right? Again, mortgage rates are around 77%. Let's say corporate borrowing costs are also elevated, and even credit card rates, for example, right, are still sitting at highs. And this is all putting a lot of pressure, especially in the private credit markets as well too, which I've discussed pretty much in detail with everyone in the private CFO Discord multiple times earlier this year in February, and just a couple weeks ago as well too. So everything is kind of just connected here, right? But again, I don't want to bore you guys here, but this is very much pretty important information. And I've been following this for the last couple of weeks. So it's, again, the bond market, right, especially the 10-year yield here, is essentially doing the Federal Reserve's jobs for them, right? So because if, for example, right now energy costs are essentially eating into the discretionary income that consumers have, right? So if energy prices continue to stay high, especially with the constant back and forth with the Strait of Hormuz, and the fact of the matter is the Strait of Hormuz is not open yet, still, and I don't think it'll be open anytime soon. And the fact that there's this constant escalation, what's happening in Iran, this entirety of this potential forever war that we're starting again can trigger again a pretty meaningful cool down and slowdown in economic activity, where it's not just what we have been discussing at the beginning of this year, which was stagflation. We can actually see a complete slowdown in economic activity, and that could actually, as a result of that, pull yields lower. So what we're seeing right now is just kind of this anticipation of that scenario, right? What I just discussed there with energy prices, and what it can do down the line. So the yields are rising, and I think it's rising in anticipation for that potential slowdown in overall economic activity somewhere around the first half of next year, which will eventually pull the yields lower and back down. And when that happens, right, the Federal Reserve will most likely cut rates. All right, so they've historically done this. If you guys just take a look at the overall, so I do a lot of reading with with the FOMC meetings and what they've done in the past. I mean, if you just take a look at the 1970 scenario as well, or when Alan Greenspan was the chairman of the Federal Reserve, and what he basically cemented the overall role of the Federal Reserve when it comes to yields, not yields, when it comes to rates and monetary policy and what they're doing now currently, right? So he kind of basically set a precedent, right? But like I said, right, if yields are dropped because of the fact that the economy starts to cool down, the Federal Reserve historically has cut rates on average, right, in this type of scenario. So if we continue to see higher yields, right, and maybe as we start to kind of cool down a little bit near the I would say end of quarter 3 or early quarter 4, I think that's when the Federal Reserve could essentially at the very least talk about cutting rates and actually decide to cut rates to kind of experiment to see how the markets react, specifically the bond markets react, right? Because they're definitely focused on yields here. So I think this is just another way that the Federal Reserve can actually depend on the 10-year yield to continue to rise, right? Because it's the long end tightening basically is what's happening here, guys. That's kind of the technical term. It's already doing the heavy lifting for the Federal Reserve, right? And it becomes a way to essentially steepen the yield curve, right, and relieve pressure on both banks and consumers without essentially quote unquote going easy on inflation, right? So again, there's been a lot of pushback again on from different news networks and stuff saying that the Federal Reserve has been going a little bit too easy on inflation, and now with this new chairman, right, Kevin Warsh, his new kind of task forces are saying that they're not going to go easy, right, on inflation, but with yields continue to rise since June's FOMC meeting, since Kevin Warsh's first FOMC meeting as chairman, the long end tightening it continues, right? So again, this is basically a way for it basically becomes a way to, again, like I said a couple seconds ago, to steepen the yield curve. If you don't know what that means, please look it up. And again, it will relieve pressure on banks and consumers without going easy on inflation. Okay, so that's my other take on this, using yields here. All right, so I think at some point the 10-year yield should be hitting at least 5%, maybe around. I mean, that's the kind of the ultimate target, I think, that I'm seeing from this, from what I'm seeing so far with all the other data and all the data points I'm looking at, all the different values, right? And that's going to cause some chaos, but that might be needed chaos to bring us back down to at least 4% or below 4%, because that will indicate economic slowdown as well too, not just from that drop. Again, that will definitely cause the Federal Reserve to convene and say, hey, we actually need to put rate cuts back on the table to delay the rising recession risk, right? Because that's what an economic slowdown can cause, right? An economic slowdown will increase the probability of a recession, right? The risk of recession. So, at that point as well, the markets will also begin to price in a greater probability for Fed cuts as well. So I'm expecting all of this to kind of occur around September or October. Okay, so again, we have the FOMC meeting on September 15th through 16th, and then the next one will be on October 27th through October 28th. Does that make sense? Okay, so what's also interesting about September's FOMC meeting is that it's going to include the SCP, right? That's the economic projections as well, right? So I think the Federal Reserve has a lot of work on their hands right now, right? As I know that they are tracking the yields here, especially the long-term yields here. And again, that's my take using the yields. That this is essentially doing the job for them, and they just have to follow whatever the yields are doing at this point. Since again, their entire objective is to follow the data, right? Week by week, month by month. So yeah, I mean, I think at some point, maybe by late summer, maybe we hit 5%, or at least near 5%, as we saw back in 2023. I mean, we saw that happening in, let's see, right here. So October of 2023, right? And that also solidified even more my take that we'll be seeing our very first rate cut after all the rate hikes that we saw in 2022 in late quarter 3 or early quarter 4 of 2024. And again, we saw that in September of 2024, right? So I'm basically holding the same perspective here, right? This is kind of a copy and paste perspective, and I think it's a right one to take, right? It's a right one to have. And I've been talking about this since earlier this year. So I think with all this new data, we're seeing kind of my view being cemented even more, even if I know that even if the markets are still saying that my take is basically wrong, I'm gonna hold on to this perspective until I am completely wrong. Yeah, so that is using the 10-year yield to kind of explain why I think we could still get one rate cut. Now, I would say the next reason that I think we could get a rate cut is inflation data, right? So we got our CPI and PPI inflation reports last week. Okay, oops. Okay, and as we've discussed previously, that CPI and PPI came down significantly. They are here. Let me even show you guys. Here's the core CPI, probably the most important data point that the Federal Reserve uses. So the core inflation rate went from 2.9% in May to 2.6% in June. So that's a 0.3 drop, right? And it's also it beat expectations as well, right? Because it's below the expected 2.8% for June, and we came in with 2.6%. And as I've discussed previously, that even the expectations was a drop, and so the fact that we beat the expectations, the estimates there, clearly indicates that there is a drop in overall prices. And again, the core CPI, if you guys don't remember, is the percentage of inflation that is excluding food and fuel costs, which tend to be very volatile, right? So with core CPI down as well, even headline CPI has gone down too. So if you take a look at PPI as well, so that has also gone down too. So a lot of people have been kind of scratching their heads, right? Even analysts, I've read some of their takes as well. They're wondering why we've seen such a huge, significant drop across CPI and PPI, and some of them are speculating that this is kind of, so this might be speculation. It's probably a speculation, but we've kind of seen the chaos that we've seen in the U.S. Bureau of Labor Statistics, right? The BLS. And what has occurred there with their the employees there, right? The economists there that work there, or even just the people who work the numbers, right? So a lot of people are speculating that they may have kind of tweaked the numbers, right, to show a very significant drop. And that could be true, or that could be true because again, they've completely brought chaos to the BLS, this current administration, because they want to make sure that the Federal Reserve can cut rates, since the Federal Reserve has that dual mandate to bring inflation down and again just overall control inflation and make sure that the labor market is stable. So that could be true, right? But we also understand that there was a huge drop in crude oil prices, right? Brent and crude oil between May and June, as we start to see kind of the overreaction to the Iran war starting to cool down and energy prices kind of coming down from their highs. So, you know, that's essentially what I believe happened. But if we were to take that speculative route, right, it would make sense that the inflation numbers can actually be another reason to believe that they could consider rate cuts again after months and months of pauses in this year alone. Just one rate cut, right? So again, June CPI came in well below estimates and expectations, right, across the board, right? And I think this was if I remember correctly, it was like the single biggest month decline, I think, since April 2020 or something like that. Okay, so you know, I think this overall argument using inflation from June's inflation prints, right, for inflation, it's starting to show possibly that the overall disinflation trend, right, disinflationary trend is about to resume, right? Because again, the Feds have been continuously working to make sure that we are staying on par with their goals, right? On course with their goals of this disinflation trend, right? So they don't want to see deflation, but they want to see disinflation, right? So the continued lowering of prices, and obviously stability of price as well. So it's possible that the overall inflation reports, when you're considering both PPI and CPI, or even just the PCE inflation report, if you guys want to take a look at that too, since the PCE report is also very important with how the Federal Reserve uses that information to judge what their next course of actions will be regarding the federal funds rate. So again, the Iran war basically created that the cost push spike that I've talked about many times already, right? And the Fed were treating this Iran war as potentially entrenching inflation, right? But again, with energy prices down, I mean, just take a look at the crude oil, right? Right, we are somewhat back down from the highs that we saw back in early March, right? And eventually we began to digest this entire rapid move up higher somewhere around early May. And it's kind of where we also saw that big drop back down to the 70s, even though the ideal crude oil, if you guys don't know this, the ideal crude oil price that market makers want to see is always somewhere between $60 to $65 per barrel, okay? And if you don't know why, please again, just Google it. It's very, very simple information to learn and know for the future. So right now we're still sitting at $81.47 per barrel here, right? And I think the fact that we've seen this drop in inflation, and I'm pretty sure they're going to address this. Well, at least Kevin Warsh will address this in the upcoming press conference on Wednesday. That this may or may not just be a single outlier of this big drop in overall inflation, right, across the board, right, with PPI and CPI reports showing significant drops, especially all the core numbers, right? And he might probably still have that hawkish tone. He's probably going to double down. I gave the reasoning why as well in the report last night. So if you guys want to read that, just take a look at the description box down below. But I think just the overall I mean, just take a look at, right, just this year alone, right? We've seen May's. So what I'm essentially trying to tell you guys here is that essentially that May's inflation reading was kind of the peak here for just this year alone. I'm not trying to think about what can happen next year, but just this year alone, if you were to see that one single rate cut, this might just be the only justification that they need from an inflation standpoint, that inflation did peak at 2.9%, especially core inflation, right, in May of 2026. And again, we can resume, right, that this peak that we saw, the zenith point that we saw in inflation, can cause this inflationary trend to resume in the second half of this year, which can again give more of a reason for the Federal Reserve to consider at least one rate cut, or at least experiment with the thought of having a rate cut, even if most of the FOMC committee members have moved their expectations for the federal funds rate higher, right? I believe almost half of the members have moved along the dot plot that they provided in the last FOMC meeting last month, showing that a lot of them have become a bit more hawkish for the end of this year. So you know, maybe that can change, right? Because of the fact that we've seen this significant drop in inflation. So this inflation report in June, right, across the board from both PPI and CPI, it's also connected to, again, back to yields, right? So if you take a look at the 30-year yield, or TNX, right, the 10-year yield, we actually saw a pretty good reaction in the yields, and bond prices went right back up since they're inversely related, right? And they actually moved sharply lower, if you see right here, between these 2 weeks, okay, and the 10-year yield, right? And I believe even the odds of a September hike, if I remember right, I was looking at the probabilities of rate hikes across the board for the rest of the FOMC meetings, and let me actually make sure to pull that up. If you guys don't know what website to use to look at the probabilities of what the markets are looking at when regarding the FOMC rate moves, okay, you look at the CME Fed Watch, okay, this is the Fed Watch tool here, right? So back in June, I was looking at the September meeting here, since again I'm still holding my perspective that somewhere around September or October we will get that single rate cut. Okay, so obviously it's changed since then, where we've seen across the board, across every single FOMC meeting into the end of this year, we've seen the probability of a single 25 basis point rate cut increasing for every single FOMC meeting, right? So the 3.75% through 4% has risen in probability across the board, at least 10% across the board. Okay, so but if I remember correctly, back in June when the inflation reports came out, the odds of a September rate hike, again, so right here, this bar right here that you guys see on this bar chart, on this specific bar chart for September, I think it was like 75%, I think. So it's still gone down, but it jumped right back up again. Okay, so I believe right before the inflation reports came out, it was around like 70 to 75%, somewhere around there. Okay, but the fact that after dropping like around to a little below 50%, I think, yeah, right here, there it is. Okay, so it was at 46.8% in about a month ago, but now we've risen right back to 54.6%, right? So I wish I can go all the way back to a week before June 26th, or even 2 weeks before, but either way, it was around like 75%, 70 to 75%, somewhere around there, and it dropped back down to like 60%, like 60 to 65%, somewhere around there, somewhere in the middle. Once the inflation reports came out, but either way, right? Either way, it was interesting to see that the inflation reports all caused a direct move in the yields as well, and that also caused the Fed Watch tool here, the CME Fed Watch tool, to also show decreased probability of a rate hike in September, October, and December as well. But it was very significant to see the September probability go down too, since again it matches with my with my perspective here for that one single rate cut around September or October for this year. Okay, so again, both inflation and the bond yields here, or the overall bond markets, are showing a similar connection here. And if we were to see confirmation that we are resuming this inflationary trend, this inflationary path that we essentially began in May, right? If we saw core inflation or just overall headline inflation peaking at on May, right, in May 2026 here, then we can seek a resumption of this trend of the overall single rate hike probability continuously going lower again, right? So, and again, I love the fact that the bond yields reacted simultaneously with that inflation report as well too, okay, as you saw here. Okay, so that is my second reason, okay, or my second specific reason to kind of believe that we will continue to see this potential rate cut, single rate cut of 25 basis points by the end of this year. Okay, now here is a third reason. Okay, so I already mentioned this. So as you guys already know, in June, in June's FOMC meeting, we saw a majority of the FOMC committee members moving along their dot plot to be more hawkish, right? And if you guys remember, back in 2023, I talked about how when the markets are becoming heavily reliant on a thing like the dot plot, it creates an opportunity for a surprise, right, to come out of the Federal Reserve FOMC meetings, right? And the bar for that surprise cut is now a lot lower, right, than people are currently thinking right now, right? So if you guys remember from June, so let's go back to June. All right, let me paint the picture here. The Fed's June projections basically showed the average median expectations for 1 to 2 rate hikes in 2026, right, which is a complete 180 from earlier expectations for 1 to 2 rate cuts, right? And this is again before the Iran war, before the energy hikes, before we saw this potential peak in inflation from May's high, and that was the official kind of outlook, right? And that was kind of the hike bias that they have implemented from last month's FOMC meeting. Okay. But again, even with that dot plot move, right, where most have moved more to the right, to flip hawkish, right, this complete 180, they still held Federal Reserve, the federal funds rate at 3.50 to 3.75%, even with elevated energy prices. Because again, in June, crude oil prices were still pretty high, right? Right, it's around $90, okay, from May to June. Okay, so this entire hawkish approach was repricing, or this hawkish reprice, right, was basically just solely built on the Iran war energy supply shock, right? And so with the fact that we are seeing this huge drop in overall inflation too now, you have to consider that there is a possibility that in the next few FOMC meetings, including this Wednesday, right, when they declare their rate decision on Wednesday, they will have to consider the fact that inflation has come back down from the highs that we saw in May, right, and the fact that even just the crude oil prices are now slowly starting to price in that maybe, just maybe, the energy price shocks and overall energy supply shocks as well. Again, you guys can have your own opinion on energy supply shocks. That's a separate issue from energy prices here. But if we were to assume or presume that both of these two issues are essentially priced in at this point in the markets. It's not too crazy to think that the Federal Reserve can actually, or the FOMC committee members, to kind of come back down with their overall outlook for the federal funds rate by the end of this year, right? So again, there's a majority of the members that moved right to the right, but maybe, just maybe, maybe in, again, just like the upcoming FOMC meeting on Wednesday, well, Tuesday and Wednesday, or maybe in September, right? They can show that in the dot plot, maybe some members have come back down, or come back to the left, right, of the dot plot. So, I would say that the fact that because they had this complete 180 flip to being more hawkish by the end of this year, again, that means that the bar for a surprise cut is now a lot lower, right? And again, when the markets rely on, or they become increasingly reliant on the dot plot itself, right? The bar for a surprise cut is a lot lower, right? So it makes sense that the markets can become, well, they become surprised by a rate cut. is what I mean by that, if anyone's confused. Okay, so we also kind of saw a similar situation in 2023 where the markets were they weren't really trusting of the fact that we should be seeing rate cuts in 2024 at all, right? And rather we continue to see rate hikes, more and more rate hikes, to completely defeat inflation and bring it back down to the 2% goal that the Federal Reserve has had since the 70s, right? So this incredulous kind of approach to rate cuts is kind of what we're seeing now, right? As the markets continue to become more and more heavily reliant on the dot plot. So again, I keep on harkening back to 2023 to 2024, which is the reason why I'm still holding this perspective that 2026 will see at least one rate cut before this year ends, especially to kind of see how the overall markets, especially the bond markets, react. And the Federal Reserve is the one that's going to be, right, the main entity to see how the bond markets react, right? And again, it's going to be, it's not even just a political suicide, but just the overall institutional suicide for the Federal Reserve to even try to implement a rate hike schedule by the end of this year, because again, yields have gone up too much and inflation has actually come back down, even though not a lot of people will agree on that, since energy prices are still pretty high and still eating into discretionary income of consumers. And again, everything's still pretty much high due to the fact that the 10-year yield is sitting at, well, it hit 52-week highs last week at 4.71%, right? So essentially, again, with the yields kind of doing the quote-unquote dirty work for the Federal Reserve and inflation numbers coming back down, I think it's overall kind of creating this perfect cocktail for the Federal Reserve and its members, especially the FOMC members, to really just focus on trying to make sure that the disinflationary trend that we have seen since last year continue, right? And hopefully that this pop that we saw in inflation numbers in May was just an interim pop, right? And in order for that to occur, right, we need to see energy prices continue their downtrend, okay? And that all comes down and boils down to the constant re-escalation and constant de-escalation that we are seeing in Iran, right? So again, the overall American consumer, average consumer, is paying for that, unfortunately, and the Federal Reserve can't really do much else. And if they try to hike rates, and especially if they decide this week to introduce a rate hike schedule, again, that's going to be complete suicide for the Federal Reserve, which again, I don't think they will do, especially with the new leadership that's been going, that's happening right now, including the new task forces, right? They're going to lose credibility. And again, I've discussed this before. Credibility is one of the main tools that the Federal Reserve has, all right? And if you don't know why, please search that up. Okay, I discussed this plenty of times, so I'm not gonna bore you guys with repeating myself there. But again, if you thought that the hiking and cutting interest rates was the major tool of the Federal Reserve, which it is, right? But it's not. It's actually the actual authority that the Federal Reserve has, right? And the credibility that it has and exudes to the American public, right? And actually the entire world. So that's kind of the major tool that the Federal Reserve has. So they can't lose that credibility, especially with the new leadership and especially with these quote unquote task forces that the chairman has implemented. So yeah, I mean, that's my entire thoughts. I know this is kind of a long stream on pretty much boring information, but I really believe this is very, very important. If you guys don't like reading numbers or just reading overall, hopefully the stream was kind of a good way to absorb the information that I've had, and hopefully I laid it out to you guys in a layman's way, right, for you guys to understand. So yeah, I think if I'm completely wrong by Wednesday, or if I'm completely wrong by September or October at that, I will still understand that I am able to read the data here, right? And continuously will monitor everything that I've been monitoring for the past couple of months since like March of this year, right? Since I believe the Iran war began in like February 27th, 26th or something like that. I think so, around there. I think late February. So, yeah. And guys, if you guys don't know anything about the yield curve inversion or what I meant by steepening the yield curve, please search it up, read on it, right? Read up on it, learn what the yield curve even is, okay? Learn what the 2-year and the 10-year relationships are, right? Yeah. All right, that is it for tonight, guys. Again, this is my take on the interest rates here, the federal funds rate, and again, the federal funds rate and the benchmark interest rates, synonymous names. Okay, they're not two different things, although they can be technically. But again, I'm not gonna get into that. But yeah, that's it for tonight, guys. I will see you guys on Wednesday at the same time. And yeah, good luck tomorrow. Thank you so much for watching. Have a great rest of your night.